Hey, it's KP coming to you live from Corona, California. Happy Halloween. And it's also Fed Week, which is a monstrous week for monetary policy for the entire world. We're going to talk about Fed Week. We're going to talk about how that impacts your money, your investments, and we're going to talk about inflation, the PCE. So let's get into it. So even though this is a very specific week, and it is Halloween 2022, I'm going to frame the specific data about this week and zoom out and tell you how it matters for your entire financial life. All this information and the way it comes in a very systemic way, in a very structured way. It's not just unique to this week. The way information flows throughout the capital markets and for financial analysts, it's very consistent. So if we can understand what news comes out at what times and what these different sources are saying to us, this information on a week like this week, which is very important, will always be relevant to the way you invest, to the way you look at money, and the way we all together take this journey to find financial freedom. So let's talk about the Fed. What is the Fed? The Federal Reserve. They are a board that was created from the Federal Reserve Act in 1913. Over 100 years old, this federal banking system has been created. Now, the reason why is to get some central control of monetary policy, some transparency in how money flows. Who decides to print more money, to buy more debt, to create more treasuries? Who is in charge of raising interest rates or lowering interest rates that impact all of us? It's the Federal Reserve. Now, the Federal Reserve Board of Governors is made up by 7 voting members. Well, they have a huge Federal Open Market Committee meeting this week where they will set the federal funds rate, which we've talked about in our last video, and we're going to talk about again because it's super important. Interest rates, which determine credit, which is what makes the world go round, is basically set in America by the Federal Reserve. Treasury rates are based off of it. Your savings rates at banks where you might save your money, car loan interest rates, student loan interest rates, mortgage interest rates for housing. It all pivots off this central rate. And this week, it's highly anticipated during the week of October 31st at their November 1st and 2nd meeting of 2022. This particular week, it is expected that they will raise the federal funds rate by 75 basis points. What will they do after that? That is the uncertainty that everyone is looking for. The world is interesting. It has about $50 trillion in credit that is out there making things happen, helping grow businesses, helping you grow net worth, helping you buy a car, get a credit card, get a home loan. There's actually very little cash in the world. Let's just say, for argument's sake, about 3 trillion in cash. So that 3 trillion in cash is levered up to $50 trillion in credit. Credit is what makes the economy expand or contract. So when you look at the credit markets and you talk about credit and you talk about people paying their credit, you take out a loan to buy something, to build a business, do you pay it back? Does that business do well? Do you keep that good or service that you borrowed loans and credit for? Do you keep your house and the roof over your head based on that credit? All of that is impacted by the actual Fed funds rate. So if the rate is higher, which is about to be 75 basis points higher, credit is now more expensive. That makes it a little bit more expensive to get a loan, to buy a home, to get a credit card. When credit gets more and more expensive, growth in the economy tends to come down. I like to use an analogy of a balloon. When we talk about inflation, all right, which is a huge mandate that the Fed looks after. If goods and services cost more, if it costs more to put gas in your tank, if it costs more to get a home loan, if it costs more to eat, these things impact our personal expenditure, our own pocketbook. Now, we talked about the CPI in the last video, and the Fed looks at multiple different things when they want to monitor inflation, that invisible tax on all of us. The Fed has always had what's called a dual mandate. They are trying to make sure that they have maximum employment for our economy, for the US economy, in addition to price stability and a stable inflation rate. Right now, unemployment is actually pretty good. We have one of the lowest unemployment rates in history, which is about, I think, 3.5% at the last reading. Now, that unemployment rate is brought out and studied by the Bureau of Labor Statistics, the BLS, the jobs report. That is a big report also coming out this week. It will always impact how you and I view the economy, view our investments. Is the economy growing? Is it shrinking? Like that balloon, is there more air going into it, or is it shrinking? When the pandemic hit and our entire country went into lockdown, people couldn't go to work, people couldn't go out, people couldn't spend money, people couldn't make money. Businesses weren't sure. There was a lot of uncertainty. How are we going to survive as an economy? How are we going to put food on the table for our family? And so that balloon, that economic balloon, started deflating, deflation. The Fed brought the federal funds rate down to zero. An unprecedented move, creating liquidity, basically free money, free, cheap money to reflate that economy. And that money was used for pandemic assistance, for PPP loans for small businesses. Many people needed help because of the health pandemic. The Fed created this reflation of money supply. Now, here we are, a couple years later, the economy's been doing fairly well, but as it goes into cycles, we are potentially looking at a recession. Typically, when we're in a recession, we have job losses. And when you have losses of jobs, people start to default on that credit, and they start to not be able to make payments for their car, for their credit card, for their home loan. In those recessionary environments, Fed is looking, and they start to say, okay, maybe we can't keep raising interest rates like they're anticipated to do this week, because they're breaking stuff. They're making things more expensive to fight inflation. But at the same time, if people are losing their jobs and the economy is shrinking because of job loss, maybe the Fed can stop raising interest rates, which also has a constricting effect on growth. The Fed wants to keep maximum employment, and they also want to fight inflation. In that balloon analogy, all the money that was put into the system to make sure that that pandemic didn't crush us and have a deep recession, that has created inflation. And that inflation, where we have maxed out the ability of our entire economy to be able to produce food, produce cars, produce houses. The supply chain was extremely strapped and really constrained in the last couple of years because of all the money that was flowing in the system, the excess of jobs. We had 11 million or more jobs open at any given time, open with a very low unemployment rate at the same time. So that all combined to create inflation. One of the things that the Fed looks at when they look at inflation is what's called the wage price spiral. If you can quit your job and go find a better paying job, and employers can't find good workers, and they're forced to pay employees more money, those higher wages that keep going up, they feed into the fact that there's more people getting higher paying jobs for less goods and services, which creates higher prices because of supply and demand. That wage price spiral, it was spiraling, which is part of why the Fed has decided to continue to raise the Fed funds rates and make things more expensive. If we're buying less goods because they're more expensive because of higher rates, then prices eventually come down because there's less demand for the supply that's out there. And hopefully that kind of ties it all together. In our last video, we talked about the CPI and PPI, which are kind of basic tools in measuring metrics for inflation. And since it's Fed week, I want to talk about the Fed's favorite measuring tool for inflation. It's called the PCE. PCE measures the consumption of all of the consumers and nonprofit organizations in America. What are they buying? What durable goods are they buying? What non-durable goods are they buying? Our entire gross domestic product, the GDP, is 70% of consumers spending money. What are we all spending our money on? Well, the PCE talks about consumption. What are we consuming? If you and I are consuming less because prices have gotten out of control, then we'll consume less, and that will show up in this PCE report, and the Federal Reserve Board will think that they're winning the war on inflation. And those numbers come out once a month, and they talk about how expensive it is for food and energy. Now, food and energy can be very volatile. Gas can go up because there's a war in Ukraine. Gas and natural gas prices can go up because OPEC has decided to cut the supply that they're putting out into the world. It could go up because it's June and people are traveling on the road. It's December and January and it's cold and people need to heat the houses. So it's very volatile for energy prices. Therefore, in the core reading of PCE, food and energy are stripped out. Food, also a very volatile component. These are things we don't control. So the PCE readings that are the core readings, they strip out the more volatile food and energy. So what are they looking at? One of the big ones is housing. Rent is going up, and that is a big component of the PCE. Also, something known as owner's equivalent rent. Now, if I own a home, but instead of owning a home, decided to rent, what would the equivalent rent be for the cost of my home ownership? These are components that make up a really big chunk, let's just say 20% of the PCE. Rent's been going up. The cost of home ownership's been going up. So are rates, by the way, because of the Fed's actions. So when the cost of home ownership and rent continues to go up, readings for inflation will show that. And the Fed is watching that PCE and seeing how expensive it is to have a roof over our head. They can't build more homes. They can't create more supply. They can't make them stop marrying and having families and having household formation. Those are things the Fed can't control. They raise interest rates, they lower interest rates. They buy more fixed income treasuries and securities, or they sell them. That's known as quantitative easing and quantitative tightening. And that's about it. That's about all the Federal Reserve can do. It's just those things right there. It's very important to watch housing prices, rent prices, especially if you're the Fed, knowing that you may break the housing industry and pull demand down so much because of higher interest rates that you ultimately end up hurting consumers. Okay, I want to talk about the stock market and how all of this intersects with each other. And then I'll give you a hot tip on caffeine in just a second. All right, the stock market is either you're buying bonds or stocks. It's stocks or bonds. Which one is it? Well, what's the difference, right? So people buy bonds such as a US Treasury, which is backed by the US full faith and credit of a US government. People invest in bonds not to lose money. If you're an institutional investor, like a bank or a hedge fund, and you are investing millions, even billions, some of them trillions of dollars, and you're investing trillions of dollars in a fixed income security like a US Treasury, it's important to know you're not going to lose that money. With the full faith and credit of the US government backing that, that is seen as a low risk, almost no risk investment when it comes to bonds. Stocks or equities is seen as a little bit higher risk. People invest in stocks and equities to make money, to risk making money, as opposed to bonds not to lose money. I'll just give you a quick little rundown if I can, since the last time we spoke. But we had a peak in yield. Okay, you can see this thing generally going up, and it hit a wall of resistance, a level where the yield of the 10-year Treasury stopped going up. So the prices of Treasuries got down so cheap and the yield got so good that people started buying money into it, started putting money into it. So you could see at this other chart, it's come back down a little bit, just since the last time we've talked. And now it's bouncing back up. So a 10-year Treasury yielding about 4% can be seen as a pretty good investment, as opposed to maybe risking it on a stock in a stock market when the economy may be shrinking. Institutional traders are always deciding, minute by minute, do they want to buy stocks or bonds? And the Federal Reserve's impact that decision for all of us. So all we could do is sit back, let these big institutional traders fight it out, decide what's going on with the economy, put out analysis based on information, and you and I can sit there and look together. Now, I am not a financial advisor. I am not responsible for your losses, only your profits. But the reason I want to put that disclaimer out is because I want to talk a little bit about stocks and investing. There are so many opinions out there. What do you do with your money? Do you want to put it in stocks or bonds or a home or just flat out save it, right? The last couple years, when the federal funds rate, the Fed, had really cheap and low rates, savings accounts weren't making any money. So what did you do with that money? Currently, the personal balance sheets are at about 1.7 trillion. Now, for the lower 50% of homeowners, there's about $350 billion in savings currently. That's about $5,500 per consumer for those that are on the lower half of earning income. That's us. That's all of us together. I've been there, I've done that. I know what it means to try and put food on the table. And when times get tough, especially if someone loses a job, you can burn through that $5,500 really fast. The Fed knows it. That's why they watch unemployment and they watch inflation. So it's a tough position to be in. You know, prices are going up, making everything more expensive, but jobs are stable. But as soon as jobs and companies start laying off because there's less revenue and slower growth out there because of a potential recession, it does change the calculus of everything and everyone. I think a very conservative way to invest in the stock market is to think 3 to 5 years out. You may not need that money in 3 to 5 years, but if you know you're going to invest it and literally not touch it for 3 to 5 years, that's a great way for your own mental health to be able to get through all the ups and downs in the stock market. I'm here to be someone that you trust together, and I'm here to help you, and I'm just going to give you all the mistakes and wins that I've learned in my journey and continue to read on your behalf and advocate for you and continue to help us all generate financial wealth and freedom. Okay, I promised you a caffeine tip. I'm actually a fun guy, and part of why I have all this energy is caffeine. I'm not advocating for caffeine because not everyone likes it. I had a period in my life where I gave it up for about 9 years. Then I had my second kid, broken sleep every night. So I'll get into the science of sleep later, maybe another episode. Everyone's brain works fairly similarly. You can train your brain the way it uses energy throughout the day. The moment you wake up, that moment, your brain is on a high. The brain waves are kicking. You may not feel it, maybe you're a little groggy, but I'm telling you, the moment you wake up from that lengthy sleep, whether it's 3 hours, 4.5, 6, 7.5, or even 9, whenever you wake up, your brain is on a high. And your brain goes through energy waves throughout the day. That's how your brain works. You start to come down in the morning about 1.5 to 2.5 hours after you wake up. That's the first time I want to have my first dose of caffeine because I want it to kick in when my brain is at a low. Some people like to get up, they like to go have a cup of coffee right when they wake up, they like the smell, they like the ritual, and I totally get that. You are building up your tolerance to caffeine when you do that. But if you want caffeine to have an impact on your brain waves and your energy, after that, let's call it 9:30. Then your brain comes up, you eat lunch, then it comes back down and you get that 2:30 feeling. Your brain is hitting another low. That's when I take my second dose of caffeine. 9:30, 2:30. Let it kick in. It will give you energy. It will space the caffeine intake. It will break down your tolerance. Make sure that you aren't building up a tolerance and need 2 cups of coffee. Hope this helps you. Let's keep our energy level up and let's find financial freedom together. Cheers.